Hi, Grant. Thank you for joining us today. How are things in Saskatoon?
Yeah, great. It's a pleasure to be with you again. And spring has sprung here in Saskatoon, as we say. So everybody's got a little bit of bounce in their step for sure.
Yeah, well, thank you for making the time. I'm looking forward to this conversation. Grant, Cameco released some very positive news in February, which included the restart of the McArthur River mine, which is the world's largest uranium mine. And it also announced the signing of long-term contracts of 70 million pounds. But before we discuss these positive developments at Cameco, I want to first start with the term market. You always say the real market is the term market, so that's where I want to begin. And because Cameco is the world's second largest uranium producer, you have insights that very few other people have. So I want to get a sense of how the current geopolitical situation is driving the term market right now. So maybe we can just start there.
Yeah, happy to make a few observations, of course. Ours is a market right now where there is a lot of uncertainty and there's a lot of change, and it's happening all at once. And I'm not going to sit here and pretend to have a crystal ball and tell you exactly how everything's going to play out. But what is crystal clear to me is that we are incredibly well positioned as Cameco to deal with the changes that are in the market. So ours was a market, you and I talked about it last time, where favorable fundamentals had really begun to take over. And that's what drove the contracting that we saw last year. It's what drove the McArthur restart decision. And I'm just going to work under the assumption that anybody who's dialed in today doesn't need to be convinced about those favorable fundamentals, the demand outlook improving, the supply outlook failing to keep pace, and not just primary supply, but also those secondary supplies, which always used to fill the gap in the market, are just not there to play the role that they have in the past. But the favorable fundamentals right now are colliding with what I think is a geopolitical realignment of the nuclear fuel supply. And it is profound, and it's going to have very dramatic effects, and we're only beginning to feel the effects right now. And so if we unpack that geopolitics a little bit, I would say the question is not if Western markets, and let me use that term really generally. What I mean by Western markets is North America, obviously, Western Europe, Eastern Europe, parts of Southeast Asia. The question is not if they're going to turn their backs on Russian supply. The question really is when and how fast. I mean, as you look across the different jurisdictions, there's really only one debate, and that is, will we have a sudden stop of Russian supply coming into the market, or will it be a ramp down in the shortest possible time in order to minimize any operating impacts upon nuclear power plants? Nobody wants the lights to go out. Nobody wants nuclear's resilience to be jeopardized. But that's really the debate. It's not, well, can we get through this and continue to buy those supplies? And let's just remind ourselves what's at stake. The Russians have global capacity in the enrichment space of 52%. Over half the enrichment market globally is the Russians. About a quarter of the enrichment service that goes into the US, about a quarter of the enrichment service that goes into the EU is supplied by the Russians. On the conversion side, the Russians have global conversion capacity of about 28%, and of which somewhere between 10 and 15% go into the US and go into Europe. So there's a very significant contribution Russia has made to global fuel supplies, and now the world is really quickly trying to disentangle from that. And there's going to be several determining factors to help us understand how quickly this can occur. And the first one, of course, is, well, there's going to have to be some destocking and some inventory drawdown in order to accommodate this. The Western demand just exceeds the Western capacity. So one place to turn is inventories. And I'm not just talking about inventories that sit with utilities. I'm also talking about the sort of in-process inventories that sit with the fabricators, with the enrichers, with the converters, and then, of course, with the primary producers of the product, which is uranium, to which we apply a bunch of those services. And we're just seeing a destocking right now. We're seeing utilities turn to flex up their fabrication contracts, flex up their enrichment contracts, flex up their conversion contracts, and all that's code for more feedstock. The world needs more uranium in the form of UF6 to feed into that void that will be created. And so that's a big challenge to figure out how that happens. Generally, when you see destocking, you also then see spot demand. You see utilities and different intermediaries jump into the market to grab any material that they can find. And so we're starting to see some of that spot pressure, and probably not build to old inventory targets, but probably restock to higher inventory targets. So that's kind of a second effect that we can expect to happen. And then, of course, what follows is the term purchasing, the full term contracting cycle that's going to call for the run rate requirement that excludes the Russian supply going forward. And what's interesting about the dynamic that we're watching right now from a geopolitical point of view is there's almost this assumption that it's up to the utilities or the policymakers in the Western world to decide how fast this is going to happen. And everybody's forgetting, well, the Russians actually get a say in this too. You know, we've seen a presidential decree from Russia talking about voluntary export restraints. What are those things Russia sends into the world that would cause pain points for those countries that are imposing economic sanctions on Russia? So it may not be the choice of the Western utilities or the Western policymakers. It may be Russia's choice to just not send the materials and sort of inflict economic pain that way. The other thing is, even if neither side goes with sanctions or retaliatory sanctions, secondary sanctions and tertiary sanctions are having a bite. It's very difficult to find somebody willing to logistically ship material that is coming from Russia. It's difficult to find somebody who'll sail into Russian waters. It's difficult to find an insurer who will underwrite those transportation links. And so there's all these cascading effects, and we just seem to be focused on the sanctions piece. But I tell you, we're feeling the effects already, and we're in the early innings of trying to untangle the Russian involvement in the nuclear fuel cycle.
So having said all of that, is there a premium on Western produced uranium?
Well, you know, I think the term market is changing in some fairly profound ways. And let me just remind you that I characterized 2021 at the time of our Q4. I characterized 2021 in the early parts of 2022 as really one where we were seeing three distinct changes in the term market. One was the tenors of term contracts were stretching out. Remember, in the past, we had an oversupplied spot market as other primary producers continued to produce material without a home and put it into the spot market. And they did that in a low interest rate environment. In response to that, fuel buyers were taking very short bites out of the term market, perhaps 2 years to 4 years or 2 years to 5 years, so they could really get that competitive carry trade, spot prices at a cost to carry, versus paying production economics for term material. But we saw tenors begin to stretch out in 2021. It wasn't uncommon to see a contract 2 to 7 years, 2 to 10 years even, really starting to stretch out. We saw time frames stretch out. You know, whereas in the past, utilities focusing on the carry trade might not have really been concerned about the end of this decade or beyond. I talked about in Q4, some of the business we did was 2030 to 2040. So we saw time frames stretching out, and then we saw volumes go up, not just because time frames and tenors stretched out, but even bigger bites out of the market. So that was already happening because of the favorable fundamentals. And now with this geopolitical shift, what we're adding to this is an origin focus. It's pretty clear that some of the recent business in the market is looking to disentangle itself, not just from Russian services, conversion or enrichment, but maybe some sources of uranium that historically have been reliant upon the Russian fuel cycle, the material in Central Asia. So it looks like that some are focused on de-risking from not just Russia, but the Russian sphere of influence. So watch this origin piece. It's really important. And then watch the demand pick up from the various actors in the fuel cycle. I mean, one of the important RFPs in the market right now is actually from an enricher who's looking for a heck of a lot of conversion that, as far as I can tell, is not available in the Western world. So an enricher is out there competing with utilities for a conversion supply, which just all indicates that there's a pinch point in that conversion service, in that feedstock, and that's pretty suggestive of good opportunities for those of us with Western capacity.
So there's a couple of things you said, and I just want to clarify, but you mentioned that some people are looking for contracts as far out as 2030 and 2040. You as a producer, how do you price that up? Like, do you actually attach a price to a contract that goes out 10, 15, 20 years?
Well, I think you'll recall, and others who are listening to this will recall that Cameco has a very strong market-related bias right now. We just look at the fundamentals, the demand outlook improving. We look at the uncertainty around supply. We look at the challenges of bringing on new assets. I mean, anybody who has pounds under the ground, they may have been discovered, but they're not licensed and permitted. You know, there's no construction plan. They're planning on building a project in a time where supply chains are in real crisis, where inflation is a real factor. We just think this all points to a structurally higher production cost economics for uranium, and we want to take advantage of that. So we have a strong market-related bias. We're willing to take a chance out in that market because we think prices are going to be stronger. So, you know, for those utilities, we just simply say, let's just price it out in that window. That's when we want to do it, and that's when we're willing to part with our material. We've got a great asset base. McArthur restarting, yes, but it, you know, under its last life of mine plan, it runs for 22, 23 years at 18 million pounds a year. So we've got assets that live out in that window, great assets. So we're willing to take that chance. So we're not really stuck on pricing it today. Having said that, we could see a very significant price post at March month end from UXC or from TradeTech with some of the business that's been done, starting to get into those prices, where you can imagine a portion of the business to be base escalated, within a significant portion of it to be market related on top of that. So the market has shifted markedly in our favor from a negotiating point of view.
And is there a sense of panic with utilities given what's going on in the world? Like, is your phone ringing off the hook? Guys are saying, Grant, you got to give me 1 million pounds or 5 million pounds?
Well, I would say it's not panic yet. And we have a customer base that I would say doesn't panic, but they go into what I'd call a security of supply contracting mode. The good news is we're actually not even there yet. So yes, we are seeing lots of inbounds. We're seeing lots of inbounds on available conversion capacity in the short run. We're seeing a lot of inbounds on available uranium capacity in the short run, in order to make sure the feedstock is there for utilities that are looking for other enrichment options. And we are beginning to see the conversations where some are stretching out their view and saying, okay, I've dealt with the immediate problem, but now I need to see a future where I am building up my supply chain from fabrication through enrichment, through conversion, through the uranium, that really de-risks me from the consequences of this geopolitical stuff. So we're beginning to see that. We're not there yet. We're not at replacement rate contracting yet. We haven't seen utilities come with volumes that equal what they consume on an annual basis. And that's all great, because we're already looking at nearly $60 uranium in the spot market. And I'm sure that term market price is going to make a rather strong jump here at month end. And we haven't even seen the leverage on top of that yet. So actually right now is not when I want it to be in that kind of panic situation, because it takes time. We don't respond with our productive capacity to meet spot demand. It's not what we do at Cameco. That's not what a responsible uranium producer does. It works in other commodities. It doesn't work in uranium. When that spot demand tightens, you want it to tighten long enough to then capture those higher prices into long-term contracts that give you full cycle value. So we're seeing a lot of inbounds. I wouldn't call it panic yet. The true moment will be when we see above replacement rate contracting. That's still in front of us.
And where is the demand coming from? Are you receiving more calls from the US, from Europe, or Asia?
In general, the demand that we've been dealing with for the past several years has been global. It's all of the fuel buyers from all of the various different markets. But no doubt, in the last several weeks, it really has been what I defined earlier as those Western markets. It's been North American It's been Western European as well as Eastern European, and that's a really critical piece as well. Those countries that had been looking to distance themselves from Russian supply for some time have now a major motivation to do that. So we expect to see terrific opportunities for us there. And it is the Asian customers as well who have taken a side geopolitically in this. So it is broad-based, and I think we're just waking up to the realization that they're not only all coming to the market at the same time, but they're coming to the same time. Different intermediaries in the fuel chain are also coming to the market looking for different components as well.
Grant, that's a great overview of the term market. I want to turn the discussion now to Cameco. You released your full year production or financials back in February, and you had a lot of positive news, including the restart of McArthur River. But what really caught the market by surprise was the long-term contracting of 70 million pounds of uranium, 30 million in 2021, 40 million in 2022. And I believe that 40 million was all done in the month of January. Is that correct?
Pretty much, yeah, pretty much.
So I guess my question is, what drove that demand in January? Because you did more in 1 month than you did in the previous 12.
Yeah, well, some of it was obviously driven by emergent issues. I mean, we saw some political unrest in Kazakhstan in early January, which our partner Kazatomprom did an incredible job managing through that, through those events, and ensuring that the sites, the uranium producing sites, were unaffected by what was going on there. But no doubt, the prospect that the country that produces 45% of the global supply of uranium was facing political and social unrest was a motivator. There's no doubt about that. But other contracts were just the culmination of the not just months, not just quarters, not just years, but the long time it takes to properly negotiate a contract in our industry. I mean, we've been talking about this pipeline of negotiations, off-market negotiations for some time, and this really was the culmination of some of those discussions. They just all kind of a bunch of them just wrapped up at the same time, and so it, I think a good indicator that there is interest, and this was all, geopolitical with Russia and Ukraine, and so we're going to see this kind of next leg of demand building on these favorable fundamentals.
So the civil unrest in Kazakhstan was just the catalyst that really brought people to the table to close the deal.
For some of them, yeah, for some of them it was, perhaps something that just brought it to conclusion. You could imagine that we're talking about market related, and our utilities were in a mood where they want to fix a lot of prices because they had a sense the price was going up in the future, but they wanted to take advantage of being a first mover, and then that kind of event says, oh, okay, let's just get the deal done. Let's lock up those volumes and we'll take that market related exposure. But we did have a couple instances where we were sort of 2 weeks between origination and conclusion of a contract as well. So there was some that definitely were responding to the events in that part of Central Asia.
So you're going to be reporting your Q1 numbers, I believe, in May. Are we going to see another similar announcement?
Well, just like we've been talking about from quarter to quarter, our team operates under a very, very clear principle, and that is a quality contract beats a fast contract every time. We don't put quarterly goals or half-year goals or annual goals on the contracting team. We just say, get the best deal possible for Cameco and its owners. Give us as much full cycle value and full cycle leverage as you can possibly get us, and that's the goal. And if it takes more than a quarter, if it takes more than a half year or a year end, there's no tyranny of those dates. And so we still have a very big pipeline. We're adding to that, as you can imagine, given the geopolitical stuff that we just talked about. We're expecting a robust continuation of our contracting activities. And by the way, this shouldn't surprise anybody. When utilities go into security of supply mode, it really becomes an incumbents recovery. They tend to, first of all, and this is really the source of our leverage, they first of all, turn to their existing contract base. And many contracts have flex options. And so we see the flex up of contracting volume. So any market-related contract we have not only flexes up with the market price going up, but then we also get a volume kicker as they pro-cyclically flex up. Second piece of leverage we have is utilities that are in a security of supply driven mode may have flexed up and hit their maximum flex up, and then they tend to come to their reliable suppliers and they say, look, I just need more volumes. We've got an existing purchase order. Let's add more volumes to it. Of course, the understanding is those are priced in a new environment, and only incumbents get that. This is not the time for utilities to be starting brand new contracting with a counterparty they've never dealt with. They're not in the mood to take CapEx risk, permitting, licensing risk. They're not in that kind of mood. They're in a mood to turn to those who already have licensed, permitted, existing brownfield capacity and can add more to their portfolio. And then, of course, as we talked about last time, all the pounds we left in the ground because of our supply discipline, those are pounds we haven't sold yet, and they're absolutely leveraged to the market. So no surprise that this is the type of response. We still continue to be very busy off market, watching the on market RFPs pick up, but that off market space is one where we can really create the full cycle value that we're talking about.
And how many RFPs would currently be shopped?
Well, what's interesting is we went for a very long period post Fukushima where I couldn't count 2 RFPs in the market at the same time. And then last fall, we started to see competitive RFPs, US utility, a Southeast Asian utility in the market at the same time. Different turnaround, different urgency, different product forms, but at least it was signaling there's more than one person with demand in the market. And then as we entered 2022 and saw some geopolitical uncertainty in Central Asia, and now with Russia and the prospect of excluding them from the nuclear fuel cycle, just 2 weeks ago, we had 3 RFPs in the market at the same time, all due on the same day. And that's what creates that critical mass of signaling where utilities, kind of realize maybe their time to have a lot of leverage over the market is over, and the market is going through a transition. And many of them pivot to off market for the reasons that I just described with respect to our leverage, and some we'll just see in the market more frequently with RFPs, and a few of them just do a bit of both. But it is starting to build towards one of those critical mass moments where, when the market seems soft, we just see that customer base leave together, and when the market starts to harden, they just kind of all enter together, and it's those moments that create the contracting opportunities we try to be strategically patient to leverage.
Grant, earlier you said we have not seen the start of the replacement contracting cycle. When will we see the beginnings of that?
Well, contracting begets contracting in our business. I mean, nothing tells a utility that it's time to get into the long-term contracting business like when others are doing it. And so the success we had last year and in the early part of this year, I think came as a surprise to many in the market who didn't realize that when we were talking about it, we had a very large pipeline of off-market negotiations. That's what we meant. And then we've seen some RFPs come into the market now, which is a very clear signal. Tenors are increasing, timeframes are increasing, volumes are increasing. That all creates that momentum where the signal is loud and clear that it's time to lay claim to future production of uranium, because if you don't, you might not have any.
Let's move on now to the restart of McArthur River. Great news for Cameco shareholders and also for the community. A lot of people are going to be going back to work. When it's fully up and running in 2024, how many people will that mine employ?
Yeah, so our plan is to obviously get that mine and the mill up and running at still a supply discipline rate. You'll remember in February, we were talking about not bringing it up to full productive capacity, which is 25 million pounds a year, not even bringing it up to 18 million pounds a year, which is where it was when we closed it down, but bringing it back to 15, and at the same time pulling Cigar Lake back to a lower level of production. And that was all in accord with the contracting success we had had. Of course, that was all pre-Russian invasion of Ukraine and the challenge of trying to exclude Russia from the nuclear fuel cycle. So who knows what the appropriate plan is, but what I can tell you is the appropriate plan is a function of building contract homes. I said earlier, we don't increase our production to try to capture transient, sometimes short-lived spot demand. We plan our production after we've captured those spot pressures into long-term contracts, and then we bring the production up to match it. So when those assets are up and running, we expect them to be around 750 employees, so absolutely essential contribution to the economy in northern Saskatchewan, direct employment, contractor employment, the business development that we drive through those operations. It really is great news for a province that is actually going to enjoy a fairly widespread commodity-driven bump here in the next couple of years, with basically everything we offer the world pricing higher right now.
Yeah, so having said all that, do you foresee labor shortages?
The great news for Cameco is that for many years, decades, northern hiring has been an absolute priority for us because it was the right thing to do, including support for all the services that we procure at our mining sites from northern-owned businesses. What this has allowed us is actually a very stable base of skilled employees who are still living in Saskatchewan's north and who want to come back to work for Cameco, who haven't been persuaded to work in other industries in the province or move across the border to work in, say, the oil and gas industry in Alberta. So that investment we've made for many, many years, you know that when McArthur is up and running, we're Canada's largest industrial employer of Indigenous people. We're rewarded for all of those investments at times like this, because we find just a great base of skilled, engaged employees who want to come back and want to work for Cameco. So we're not foreseeing any challenges there.
And Grant, maybe you can just take us through the timeline associated with the restart.
The key for thinking about the McArthur River mine restart and the Key Lake mill restart is just the reminder, we don't push these assets to meet spot demand. And I just can't say that enough. In fact, by definition, a typical term contract doesn't start delivery for 2 years out. So that affords us the opportunity to be very efficient and very deliberate in the decisions we make. And right now, as you hear time and time again across the commodity space, supply chains are a challenge. And supply chains are a challenge that's creating inflationary cost pressures. And we have no interest in chasing inflation here at Cameco. We don't have to chase inflation. So we're going to sequence that restart to really be as planful and strategic and as risk controlled as we possibly can be, with an eye towards those homes that we have for the production. So what we've said is that this year there could be as much as 5 million pounds of production, but it's actually only 1 million pounds of production at the McArthur River mine, because we got 4 million pounds of broken ore ready to go for when the mill can start commissioning. So all eyes are on the mill at Key Lake. The focus there is on finishing a couple of key projects that we've been working on to digitize and automate that mill and really set it up to be the mill of the future. Investments that we're very excited about. And then we put out guidance for 2024, suggesting those two assets will be at 15 million pounds a year, and at the same time we'll toggle back Cigar Lake. We haven't put out 2023 guidance because we're not in a rush to do this in any other way except strategically, deliberately, and effectively.
Hey Grant, I just want to clarify one point. You said earlier that when McArthur is up and running, Cigar will pull back its production from 18 million pounds to approximately 13 million pounds annually. Why the pullback in production at Cigar?
Yeah, well, if you remember, a really long time ago, back in February of 2022, when the world was a little bit different than it is today, we're still in supply discipline mode. We had a lot of contracting success. We make our planning decisions based upon the homes that we have under the contract portfolio. And based upon what we had signed so far, it made sense to bring back McArthur, but not bring it back at full capacity. And we were in a market where it didn't make sense to push ahead and continue to exhaust phase one of Cigar Lake without a clear sight to what we would do around phase two of Cigar Lake. And so no surprise, our joint venture partner in that mine agreed that neither of us had an interest, but things have changed a lot. The market has moved, prices have moved, a lot of demand on market and off market has begun to come our way. Those plans could now change for sure, but they were made in a pre-Russia Ukraine environment. Gosh, you know, we would absolutely love to be in a position to bring those assets back to full capacity. Wouldn't that be wonderful? But we wouldn't do it until we had the homes for it. And that just takes time to build those homes. So more to come on what those planning decisions look like.
Grant, I want to move on now, and I want to discuss investors and what buy-side clients are doing. I believe it was just in the last couple of weeks, Caxton, a large macro fund based in New York, recently filed that it purchased $250 million worth of Sprott Physical Uranium Trust. Are you getting a lot more calls from hedge funds and long-only funds and family offices, given the move that we saw in 2021, but also in Q1 of 2022?
No question. And it is right across the board. We are talking frequently to, you know, the energy investor, the clean energy investor. We're talking to the geopolitical investor, the interest from the traditional mining investor that has always been the anchor to us. That has gone up. As you look at this commodity and recognize that this challenge of building enough Western supply capacity to meet Western demand in a post-Russia world is a real challenge that's suggestive of prices still to go higher. For an incumbent producer with tier one assets, it puts us in a great position. So there is no doubt origination is up. Lots of inbounds, lots of introductory calls, and you know it's just a symbiotic relationship with the financial investments, because you know people want to understand the market a little bit better, so they talk to us, and then they go and they talk to folks like at Sprott or at Yellowcake, and that usually raises some additional questions which come back our way. And we're just finding the investor level of understanding is going up dramatically, especially on this key point that investors should never back a uranium producer that says their strategy is to dump into the spot market. And we're just seeing more and more investors who just get that. They realize it doesn't behave like other commodities.
So as I mentioned earlier, uranium was up 50% in 2021. It's up 30% in the early part of 2022. I'm not going to ask you where the price is going because I know you're not going to tell me. So I want to frame it in a different way, and I'm going to use a baseball analogy. What inning are we in?
Easy analogy for me to make because I used it in February. We're in the early innings. We're in inning 2 and no more than that. We have just begun to see the favorable economics. We weren't even at replacement rate term contracting on the favorable fundamentals. And now we have a bit of a crisis setting in, which is just going to drive additional urgency. And one of the things that I've been pointing out for some time is that I didn't know what the shock was going to be. I didn't know where it was going to come from, but I was looking at a market that had neither the primary productive capacity nor the secondary supplies to absorb a shock of any significant size. This market just was very vulnerable to a supply shock, and it's come now, and we've only begun to see the effects of trying to disentangle from the Russian fuel cycle. So we're still in the early innings of this game.
Grant, now that the world is opening up again, are you on the road meeting with investors and utilities?
We are. About 5 weeks ago, things just went back to normal. We've been on the road through North America, been on the road in Europe recently. I wear a lot of hats at Cameco. It's a privileged position that I'm in, but whether it's the CFO responsibilities or the responsibilities I have for global marketing, there's no lack of interest in hearing from Cameco and seeing Cameco. So yeah, it's busy again. It's great. I mean, ours is a small industry. It's relationship based. It's great to be back in front of customers. It's great to be back in front of investors and regulators and all of that. And certainly welcome. If this is the new normal, I certainly welcome it.
Is there anything else you would like to communicate to the market before we wrap it up?
You know, as always, a great set of questions. You really have your finger on the pulse of what's going on in this industry. But just maybe one last comment. I mean, I think people can all agree that all Cameco has done for the last number of years is exactly what we said we were going to do, which is be supply disciplined, be financially disciplined, not front run the demand transition with supply that wasn't yet required. And we're going to continue to do exactly what we said we were going to do, and we're going to capture full cycle value for our owners, and our strategic patience will be rewarded, and that's the plan.
And Grant, maybe you can just summarize what investors can expect in terms of news flow in the coming months from Cameco.
Well, news flow will continue to focus on performance on the contracting side, with the caveat that it's not quarterly driven, it's not half year driven. Obviously, we'll report on the success that we're having there. We'll talk about how things are going at McArthur and Key, and remind people that ramp up is for material that's already been sold, not for material yet to be sold. We don't play that game, and just continue to deliver on a strategy of appropriate supply discipline, appropriate financial discipline, and be strategically patient for this market to fully recover.
Well, Grant, I want to thank you for spending time with us today and providing great insights on both Cameco and the overall uranium market. Once again, thank you.
Yeah, thanks to you, and keep up the great work. I think this is a great series that you run, and we're just delighted to be a part of it.
Thanks again.